Hey, welcome back. Let me ask you something honest. How many times have you entered a trade that looked good, had a clear setup, followed all the rules you knew, and still lost? And when you look back at the chart afterward, you realize the market was actually moving in the complete opposite direction to what you were trading. That is not bad luck. That is a market structure problem. And it is the single most common reason retail traders lose money consistently without understanding why. Market structure is the foundation of every single winning trade. It tells you the direction the market is moving, where it is likely to go next, and when a trend is strong versus when it is about to reverse. Without understanding market structure, you are essentially driving with your eyes closed. You might get lucky for a while, but eventually you crash. Today I'm going to explain market structure completely, from the most basic concepts all the way through to how professional traders use it to make high probability trading decisions every single day. By the end of this video, you will understand exactly what market structure is. You will know how to identify bullish and bearish structure on any chart. You will understand when structure is strong versus when it is breaking. And you will know exactly how to use structure to time your entries and exits with far more precision. Let us get into it. Hat is market structure, and why does it matter? Market structure is simply the pattern of highs and lows that price creates as it moves through time. That is it. That is the definition. But do not let the simplicity fool you. The pattern of highs and lows on a chart tells you everything you need to know about who is in control of the market at any given moment. Whether buyers are in control or sellers are in control. Whether the trend is healthy or showing signs of exhaustion. And whether you should be looking for buying opportunities or selling opportunities. Here is why this matters so much. Most beginner traders look at indicators first. They look at RSI readings and moving average crossovers and MACD signals. And indicators are useful. We talked about them in previous videos. But indicators are derived from price. They are calculated from what price has already done. Market structure is price itself. It is the raw truth of what the market is doing. When your indicators conflict with your market structure, structure wins. Every time. Think of market structure as the map of the battlefield. Before you send any soldiers in, you need to know the terrain. You need to know which direction the forces are moving. You need to know the high ground and the low ground. Market structure is that map. And here is the most important thing about why market structure matters. It removes subjectivity. When you learn to read market structure correctly, the chart tells you clearly what is happening. You are not guessing, you are not hoping, you are reading an objective story that price is writing in real time. The building blocks, highs and lows. Before we can talk about market structure, we need to define the two building blocks it is made from. Swing highs and swing lows. A swing high is a candle or group of candles where price reached a peak and then pulled back on both sides. The candle at the top of that move, with lower candles on both the left and right side of it, that is a swing high. A swing low is the opposite. Price reached a bottom and then bounced on both sides. The candle at the lowest point of that move, with higher candles on both sides, that is a swing low. These swing highs and swing lows are the anchor points of market structure. They are the reference points that everything else is built from. Now here is the critical skill. Learning to identify significant swing highs and lows versus minor ones. Not every small wiggle in the market is a meaningful swing point. You are looking for the notable peaks and troughs, the ones that represent a genuine shift in momentum before price moved meaningfully in the other direction. A good rule of thumb for beginners is to look at the chart from a slight distance. The highs and lows that clearly stand out when you are not zoomed in too close. Those are the ones that matter for structure. Once you can identify swing highs and swing lows reliably, you have the foundation to read everything else we are about to cover. Bullish market structure. Now let us talk about what bullish market structure looks like. Bullish market structure is defined by one specific pattern: higher highs and higher lows. Let me explain what that means in plain terms. The market moves up to a peak, that is, a swing high. Then it pulls back down, but it does not pull back all the way to where it started. It pulls back to a higher point than the previous pullback. That pullback low is a higher low. Then price moves up again and makes a new peak that is higher than the previous peak. That is a higher high, then higher low, then higher high again, then higher low again. This staircase pattern moving up and to the right is what a healthy uptrend looks like. Buyers are consistently in control. Every time sellers try to push the price down, buyers step in at a higher level than before and push it back up even further. Here is the key insight for trading bullish structure. In a healthy uptrend with clear higher highs and higher lows, the higher low is where you want to be buying. When price pulls back from a high and starts forming a new higher low, that is your buying zone. That is where smart money is adding to long positions. That is where the risk to reward on a long trade is most favorable. You are not chasing the price at the top of the move. You are buying the controlled pullback in a confirmed uptrend. This is one of the cleanest and most consistent trade setups that market structure gives you. Bearish market structure. Bearish market structure is the mirror image of what we just covered. It is defined by lower highs and lower lows. The market falls to a trough. That is a swing low. Then it bounces up. But it does not bounce all the way back to the previous peak. It bounces to a lower point than the previous bounce. That bounce high is a lower high. Then price falls again and makes a new trough that is lower than the previous trough. That is a lower low, lower low. Then lower high, then lower low again, then lower high again. This staircase pattern moving down and to the right is what a healthy downtrend looks like. Sellers are consistently in control. Every time buyers try to push the price up, sellers step in at a lower level than before and push it back down even further. The key insight for trading bearish structure is the same logic in reverse. In a clear downtrend with lower highs and lower lows, the lower high is where you want to be selling or shorting if you trade on the short side. When price bounces from a low and starts forming a new lower high, that is the zone where sellers are stepping back in. That is where smart money is adding to short positions. That is where the risk to reward on a short trade is most favorable. And even if you do not trade on the short side, understanding bearish structure tells you clearly when you should not be buying. Do not buy in a clear downtrend and then wonder why the trade does not work. When structure breaks, the most important signal. Now we get to the concept that advanced traders watch more closely than almost anything else. Structure breaks. A structure break happens when the current pattern of highs and lows is violated in a meaningful way. In an uptrend with higher highs and higher lows, a structure break occurs when price falls below the most recent higher low. That lower low tells you the uptrend structure is potentially broken. Buyers fail to hold the level they previously held. The balance of power may be shifting. In a downtrend with lower highs and lower lows, a structure break occurs when price pushes above the most recent lower high. That higher high tells you the downtrend structure is potentially broken. Sellers failed to hold the level they previously held. The balance of power may be shifting. Structure breaks are the earliest warning signal of a potential trend change. They are not a guaranteed reversal, but they are a clear warning that the current trend is under threat. Here is how professional traders use structure breaks. When they are holding a long position in an uptrend and a structure break happens, meaning price takes out the most recent higher low. That is often their signal to exit the trade or tighten their stop loss dramatically. The reason they entered the trade in the first place was the uptrend structure. If that structure is broken, the original thesis is compromised. And when they are looking for new trade entries, a structure break in one direction, followed by the market beginning to form new structure in the opposite direction, is one of the most powerful early entry signals available. The break tells you something changed. The new structure forming confirms which way it changed. Change of character, the confirmation after the break. There is a concept closely related to structure breaks that professional traders use called a change of character. A change of character is the first sign that the market is shifting from one type of behavior to another. Here is a specific example. Price has been in a downtrend for weeks. Lower highs, lower lows. Sellers completely in control. Then something different happens. Price makes a new low but immediately bounces back with unusually strong momentum. It pushes above the most recent lower high. That is a structure break in a downtrend. But more than that, the way it moved was different. The bullish candles were large, the move was aggressive, there was real buying pressure behind it. That aggressive bullish move that breaks the previous lower high with strength, that is a change of character. It tells you the nature of the market is changing. Sellers are losing their grip. Buyers are stepping in with real conviction. A change of character does not guarantee a full trend reversal. Sometimes the market will try to reverse, show a change of character, and then resume the original trend. This is why you always wait for confirmation. The pattern to look for is this: change of character first, then the new structure beginning to form. Higher high forms after the change of character in a previously bearish market. Then you wait for the first higher low to form. When price pulls back and holds a higher low, you now have confirmation of new bullish structure beginning. That is your entry zone, the first higher low after a confirmed change of character. How to use market structure to time every trade. Let me now put everything together into a practical framework you can use on your next trade. Step 1. Identify the higher time frame structure first. Before you look at any lower time frame chart, look at the daily or weekly chart. What is the overall structure? Is it bullish with higher highs and higher lows? Is it bearish with lower highs and lower lows? Is it ranging with no clear direction? This is your map. This is the environment you are trading in. Step 2. Only take trades in the direction of the higher time frame structure. If the daily chart is clearly bullish, you are only looking for long setups. You are not fighting the trend by looking for shorts just because the 1 hour chart pulled back. Step 3. Use the lower time frame to time your entry. Once you know the direction from the higher time frame, drop to a lower time frame to find your specific entry point. Look for the pullback to a higher low in an uptrend. Look for a small change of character on the lower time frame at that higher low zone. That is your trigger. Step 4. Set your stop loss below the structure. Your stop goes below the higher low you are buying at. If that low breaks, the structure that justified your trade is gone. You exit with a controlled loss. Step 5. Target the next significant structure high. Your profit target is the next clear swing high on the chart. That is where resistance is most likely to appear. Take your profit there or trail your stop as price moves in your favor. Let me bring this all together. Market structure is the pattern of swing highs and swing lows that tells you who is in control of the market at any given moment. Bullish structure is higher highs and higher lows. Buy the pullbacks to higher lows. Bearish structure is lower highs and lower lows. sell the bounces to lower highs, or simply avoid buying. Structure breaks are the earliest warning that a trend is changing. Watch for them carefully. Change of character is the first aggressive move that violates the previous trend. It signals a shift is beginning, and your practical framework is always this. Higher time frame structure gives you direction. Lower time frame structure gives you timing. Stop below structure. Target the next significant level. This one concept, applied consistently, will improve every trade you take from this point forward. If this video gave you real clarity on market structure, please hit that like button and subscribe. Share this with one person who is struggling with their trading. It genuinely makes a difference. Drop a comment below and tell me one thing. What time frame do you primarily trade on? I want to know, and I will give you specific structure tips for that time frame in the comments. I will see you in the next one. Trade safe.